Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these Monday market updates, 9 a.m. Eastern, every Monday morning. Get you ready for the week. Some of the stocks I'm watching. Great video for you this week. Saying you should invest when there's blood in the streets or be greedy when others are fearful, like everyone likes to says, and then actually doing it, something impossibly difficult at times, right? When stocks crash, you're just thinking about protecting your hard-earned money, not really putting more of that money at risk, which is actually what you should be doing. The best time to invest in these stock market crashes. While it does look like futures, looks like the stock market is going to be up today on that backstop by the FDIC of the SVB's depositors. So we're seeing a lot of that risk from the bank collapse come out of the markets. Looks like stocks are going to be up, but we're still dealing with the fastest rate increases, interest rate increases in 40 years. A lot of those interest rate increases haven't been felt in the economy yet. We've still got our earnings recession that we're working through, high interest rates. We've got two inflation reports coming this week that could set the market coming back. So probably looking at lower stock prices. And I want to show you, what you can do to make it easier to invest right now, putting some numbers behind here, because, putting some numbers behind this can actually, when you should put your money to work, when you should start investing, and how to do that by watching those valuation measures can at least give you some reassurance and some assurances to know that even if stocks do continue to fall a little bit, you're going to have gotten in on a great price and, eventually really make some good money in that next bull market. So I'm going to show you some historical valuation multiples, right? When is the best time to buy in different groups, growth stocks, real estate stocks, dividend stocks, a lot of those stock groups that have different valuation measures for when you should actually be putting your money in. I'm going to walk you through those and how to do that. Before that, though, if you are looking for a great place to park your cash, to really earn a return on your cash while you're waiting for the stock prices to come down to these valuation measures that we're going to be talking about, I just started investing here in a no penalty CD from CIT Bank. This thing pays a 4.1% yearly interest, annualized interest, among the best of these CDs, and it's a no penalty CD. So you've got always got access to that cash. You can get your cash out without paying those penalties. It's daily compounded interest, so you can get your interest every single day on that account. I use it along with a treasury bill ladder I'm going to be talking about in a video on Wednesday. I'll leave a link to the CIT Bank in the description below. So here I'm going to use a couple of different resources on how to find those valuations in different groups of stocks. We're going to look at the overall market, the financial sector, so bank stocks. We're going to look at growth stocks. We're going to look at real estate stocks, and then through some of these other sectors, what valuation measures you want to use, whether it be the price to book ratio, whether it be use FFO, so funds from operations, things like that, to know when stocks in that group are low enough, are a good enough value that you can invest, you can jump back in the market and be confident that you're going to make a good return on those, even if stocks keep on coming down a little bit. To find the valuation on the overall market, and this is a resource that a lot of you are going to recognize because I use this all the time. I love the FactSet Earnings Insight. To find this, if you need to find this, you just type in Google FactSet Earnings Insight. So you do that. You go here, it's going to be usually going to be the first one, FactSet Earnings Insight. You click on that, it's going to take you to this report. It's a weekly report. They come out on Friday. They're going to analyze the stocks in the S&P 500. So the largest 500 companies, they're going to get analyst expectations for earnings over the next year, as well as trailing earnings. So this is what we're looking at here in this one. In this graph, it's the S&P 500 year bottom-up EPS actuals and estimates. So this is what analysts on Wall Street are expecting the 500 largest companies to produce as far as aggregate earnings across all 500 of them, in the past and here in the next couple of years. Here we see that S&P 500 companies did report about $219 in earnings over the last year. So this is how you get this market valuation. If we look at the S&P 500, so right around 3,900. So if we come back here, if we do 3,900 divided by $219 in earnings, that means right now the S&P 500, the broad market, is valued at about 17.8 times on that trailing earnings. Here we see that we're expecting about $223 in earnings over the next year. So we're expecting about a 2% increase in earnings. Again, I think that is overly optimistic. We are already in an earnings recession. We're expecting companies in this index, in the S&P 500, to report 2 more quarters of declining earnings. I think the declines are going to be more than expected. I think this is probably going to be, with a recession, probably going to be closer to about $210 in earnings. But if we look right here, just what they're expecting right now, $223, then that means right now, 3,900 divided by this 223. Right now, on a forward basis, stocks are trading about 17.5 times PE, price to earnings, on that forward basis. And now we can look at a couple of other charts here in the report to see kind of how that compares to history. Basically, what we're trying to do here, folks, is look at what the current valuation on stocks is and how that compares to history to see if we're getting a good deal right now, or if maybe we want to wait a little bit to see, if stock prices do come down and if we can get a better deal in the future. So what we're looking at here, again, we said that stocks right now at that 3,900 on the S&P 500, and $219 in earnings over the last year, trading for about 17.8 times earnings on that trailing basis. Here we see the history for this S&P 500 trailing 12-month PE ratio, the price to earnings ratio. Here with this dash blue line is the 10-year average. The green dash line is the 5-year average. And here the 17.8. Which you can see, historically, it's not a bad time to buy. We do expect when stocks get back into a bull market here over the next few years, eventually they will hit 20, 22, even 24 times on a price to earnings basis. You can see here in the last bull market, in the craziness after the pandemic, stocks actually hit about 33 times price to earnings. So yeah, buying in at 18 times price to earnings, you would make a pretty good return as stocks come up. It's not quite where I want to be, though. Not quite where I want to buy into stocks, where I get excited about stocks. You can see here that in a recession, we do have data from Deloitte that says recessions usually knock about 10% off of stock earnings. So if we look at, I've been predicting about $210 in earnings. $210 in earnings this year. If we take maybe a 16.5 or 15 times earnings, if we do 16.5 times what I'm expecting for earnings, $210 over the next year, after, as we get into a recession, then stocks would be about closer to about 3,500 is where you want to look at them. Okay, this is just kind of how I'm thinking about stocks when I get excited about buying into stocks. When I think they're a really good deal, it's going to be about 3,500 on that S&P 500. That's when you get about $210 in earnings times 16.5. And if you look at this chart right here around just above the 16 line, that's typically over the last 10 years anyway, has been a very good time to buy into stocks. You can be confident that even if stocks fall a little bit further, if you're buying in at 16.5 times on that price to earnings, you're getting a really good deal. So again, this is something you want to think about when you're trying to think of, okay, do I buy the dip now? Are stocks cheap right now? Or do I want to wait a little bit until valuations come down a little bit further? Now, for growth stocks, for tech stocks, for internet stocks, a lot of these, you can't really use the PE ratio only because they are typically trading at 20, 30 times and even more on that PE ratio, which makes them look overly expensive versus some of your safety stocks, some of your value stocks trading at 10 and 15 times on a price to earnings basis. In this instance, I like to use the PEG ratio, okay? This is the price to earnings divided by the growth in those earnings. It adjusts for those normally high PE values for outsized earnings growth. So you got a lot of these tech companies, like Tesla, you got a lot of these tech and internet companies that are growing their earnings by 10, 20, 30% and even higher, growing those earnings by 30% a year. Investors are just naturally going to pay a higher price for that earnings growth. So what you do is you take that PE ratio. If a stock is trading for a PE ratio of 20 times, 30 times, then you divide it by the earnings growth. And I'm going to show you an example here that is going to kind of adjust that down, and I'm going to show you, when is a good time to buy into those stocks. So here you've got Nvidia Corporation, ticker NVDA, that leader in semiconductor growth. Definitely a growth stock, definitely a stock that you want to adjust for this growth, because if you just look at the statistics here for the company and the price to earnings of 135 times earnings there. So if you were just going off of comparing this against maybe some other stocks that were trading at a 10 times price to earnings or 15 times price to earnings, there's no way in hell you would ever buy shares of Nvidia, right? But what you've got to do is you've got to adjust that price to earnings ratio for the earnings growth with this PEG ratio. Okay, and they actually give you that here. I'm going to show you how to calculate it just so you can kind of double check these numbers and do that on your own. So actually what they're doing, and you can actually back into this to see what kind of earnings growth they're using and kind of double check the numbers. But if they're saying that the price to earnings to growth ratio is 3 times, and they're using a 5-year expected. So they're using the expected growth rate in earnings to calculate this. I'm going to show you a little bit different way, but you can find what the growth rate they're expecting is for this stock. So if you divide 135 divided by 3, then you get 45. So they're expecting 45% annual earnings growth from this company. Now, what we can also do, we can go to this analysis tab here on Yahoo Finance, and you can get this on any stock investing platform. I'm using Yahoo Finance because it's a free resource that everybody's got available here. So we've got the analyst estimates for earnings and revenue here on this tab. You got the average estimate here, and you can see that for 2024, the current year, and just because how Nvidia reports its years, it is actually in the fiscal year 2024 right now. So we're going to use that current year, 446, and last year's was $3.34 in earnings. So just the growth of earnings this year, they are expected to continue or to get back that earnings growth divided by 3.34. So Nvidia is expected to do 33% earnings growth this year. We can do next year. Here's 587 divided by 446. Expected to grow earnings by 31% next year. So now what we need to think about is, they're using a 5-year expected earnings growth. They're saying that earnings is expected to grow by so much a year. I'm going to use just the average of these 2 years, okay? Because we are much more sure about more or less what Nvidia is going to grow over these next 2 years than the 5 years. I don't think anybody can really predict with any degree of certainty what the earnings are going to grow over the next 5 years. The next 2 years is a little bit better, a little bit more confident on that. So if we got about an average 32% earnings growth over the next 2 years. So again, we can come back to this PE ratio, which is 135 times price to earnings ratio. And we can adjust that 135 divided by 32, that 32% earnings growth over the next couple of years. That gives a 4.2 times on price to earnings to growth. Okay, and you can see it is still a little bit high compared to what it's traded at in the past. Here in 2022, it traded at 2.6, 2.4 times. Before that, in the past, it's traded as high as 3 and 4 and 5 times. So, it's not expensive, but it's not cheap here either. There are still a lot of great growth companies growing their earnings by 20, 30, 40% a year. When you adjust their price to earnings ratio down, you get something closer to a 2 or 1.5, 2.5 times on that PEG ratio. That's where I like to see it. I like to see that PEG ratio down 1.5 times. Optimally under 1 would be great, but I usually want to wait on those growth stocks till I get to a PEG ratio of 1.5 times or lower. That's when they are truly attractive valuations, and you can be confident. Again, this is what we're talking about here, folks, trying to find where those stocks are that you can be confident at buying them and know that you're getting a good deal, even if stock prices continue to fall. So for these growth stocks, you want to adjust those valuations, that PE valuation down with its growth, and you want to look for when it gets down to about maybe 1.5 times on that PEG ratio to really start getting excited about buying those stocks. Real estate stocks. Now, I want to talk about real estate stocks because like growth stocks, you got to value them a little bit differently. With real estate stocks, because real estate has so much depreciation on that income statement, you can't use earnings as a guide you can't use the PE ratio as a guide because earnings really don't reflect true cash flow of a real estate company. So what we're going to do, we're going to use the price to FFO valuation, the price to funds from operation value or funds from operation. That's the valuation you want to find to know if you're getting a good deal on real estate stocks. Where we're going to find that is the NAREIT, the National Association of REITs. It's a great resource for following your real estate stocks. First, we're going to go to this REIT data up here, and we're going to go to market data, REIT market data in the NAREIT. And you're going to come down here to this REIT watch. It's a detailed monthly public traded REIT industry data So you're going to click learn more there. This is a great resource. A lot of great data from NAREIT here. You're going to scroll down here, find the current one, click on there, and I've actually got that up already. And here you're going to scroll down almost to the very end. Here on about page 39 is when it starts. These gives you the FFO calculations. Here we go. It's these, and they'll do it by property type. Again, folks, when you're looking at those real estate investment trusts, these real estate stocks, you need to think about it on property types. You can't think of all real estate stocks together because these different property types trade for different valuations, right? What might be a cheap valuation on an FFO basis for one property type might be very high for another. And we're going to see that when we look through some of these numbers. So here we're in residential real estate. So these apartment REITs, and you can see here, they've give you FFO per share estimates for each of these. According to NAREIT, you get the current share price, you get the price to FFO estimates. That's what you want to look at here. This 2023, they have estimated 2024 FFO price to FFO estimates as well. So they're taking the current price divided by the expectations for funds from operations for each of these stocks on a 2023 and 2024 basis, and then the average for each sector. I know this is a little bit small here. Let's see if we can increase the size here to see a little bit bigger. Okay, so what we can see here is in the apartment REITs right now going for about an average of 18 times price to FFO, price to funds from operations. And we can see here some of the cheaper ones in here. We can see that this the Essex Property Trust trading for just 15 times price to FFO, right? You've got Next Point Residential Trust trading for 15 times versus 31 times for Veris. So you can get a good feel for within each property type, which are the more expensive, which are the less expensive companies. You can do that manufactured homes, single family homes here. They've got the diversified ones. They've got healthcare, one of my favorite ones. So we'll look at Medical Properties Trust. All you out there know in the nation know I've been following that stock. Really like Medical Properties Trust. We can see here MPW. We go over here. It is trading right now for an FFO of, or price to FFO of just 7.3 times. Here we are. Price to FFO estimates 7.3 times. Now, what you got to understand here is all healthcare REITs, all healthcare real estate has been trading at a discount over the last year, just because some of the specific environment or the factors that healthcare REITs are going through. They're going through a lot of solvency issues for those healthcare facilities. Of course, that is flowing down into the real estate owners as well. And we still see here that on average, healthcare REITs are trading for just 12.6 times on a price to FFO basis. So that is a lot cheaper than we saw in that in that residential sector. It's cheaper than a lot of these other sectors. So you're not only getting with some of these healthcare REITs like MPW that is trading for just 7.3 times on a price to FFO basis, you're not only getting a cheap stock, a inexpensive stock on a valuation basis, but you're getting one in an industry that is trading cheaply as well. So you're getting getting a really good deal on those, I think. And you can look through here, lodging and resorts still trading for about a 9 times price to FFO basis. Now for other individual sectors, so some of the sectors we didn't cover, we're going to again go to this FactSet Earnings Insight Report and then down to this S&P 500 sector level forward 12-month PE ratios. Okay, so what this is telling you in these dark blue bars here, this is the forward PE. So this is the current price of all the stocks in each sector of the economy. 11 sectors of the economy, from consumer discretionary, technology, staples, industrials, real estate, as well as the S&P 500 here in the middle, that broad general stock market average. With the blue bar is that forward price to earnings. So the price of all those stocks in each sector divided by the earnings expected over the next year. So the earnings of all the stocks in that individual sector over the next year, the price to earnings ratio for that. And you can see this blue bar. The green bar is the 10-year average, so kind of a historical average of valuation of where those stocks have traded. And you can get a sense of which stocks or which sectors are expensive and which are cheap. In most recent report here, we see the stocks in the financials. If you look clear over to the right here, stocks in the financials are trading for 11.9 times on a price to earnings ratio. That's actually even down a little bit after last week's huge sell-off compared to a 10-year average of about 13 times price to earnings. So stocks in the financial services sector, that's your banks, that's your insurance companies, trading for a steep discount to that price to earnings ratio. We do see with that backstop by the FDIC for SVB depositors, we see a lot of that risk coming out of that sector. I think that sector is going to do very well here over the next year as those interest rates bring in that net interest income for those stocks. So you got that. You got this communication services sector. Now, this communication services sector here trading for about 15 times on a price to earnings basis versus about 15.8 times long-term average. So it is also trading for a discount compared to that long-term average. Now, what you got to understand here with communication services, this is kind of a hodgepodge of telecom stocks. So AT&T, Verizon, things like that. Your streaming stocks, so Warner Brothers, your Disney, things like that, as well as your internet names. Okay, so these are a lot of different ones. Really, the sell-off in the internet names like Facebook, like Disney, like Warner Brothers, really has brought down the valuation in this sector, and that's why we're seeing a discount here in the stocks in that sector. But I do think those valuations are attractive right now. Some stocks I'm watching for this week, definitely the bank stocks are going to be very volatile this week. Got crushed last week when SVB Financial had to seek new capitals and investors, and then finally collapsed. Second largest bank collapse in history, after the 2008 collapses there. And it could be an industry-wide problem. Obviously, getting that news from that the FDIC is going to backstop those depositors, going to take a lot of risk off this. We can already see that the iShares U.S. Regional Banks ETF, the IAT. We're also looking at the KRE, the ETF. Those are the two main regional bank ETFs that really took it hard last week, down about 15% last week just on that news alone, are up in the pre-market. So these are probably going to be rebounding a little bit. There is still going to be some fear in the market that, there is more pain to come in these regional banks. So you might want to hold off for a week or two, but there's getting some very good valuations in these, especially some of the larger banks. I would instead look to maybe the KBE, that is the S&P Bank ETF. This is going to be the larger banks, your banks and if you scroll down here on Yahoo Finance, it's going to show you the top holdings there. You're going to have, like BlackRock, you're going to have Citigroup, you're going to have the larger banks here. SIVB was in that. That is obviously going to change right now, but you're going to have a lot of the larger banks and larger institutions in that. You can look at that. You can look at the XLF, which is going to include all the banks in the financial sector in the S&P 500. You can have that. You can have all the life insurance companies in there, as well as it is a financial sector ETF, ticker XLF. I think you go with the larger banks here, the banks like Citigroup, JP Morgan, Wells Fargo, Bank of America. It's going to be in these large funds like the XLF, like the KBE. So you're going to be avoiding some of those problems in smaller regional banks, and you're going to get better deals here in the larger bank ETFs. Another one I'm watching this week, Lithium Americas, ticker LAC. It's going to report its earnings on Thursday. The company expected to finally start generating revenue this year, so that could be a big mover for this company. The stock has been caught up recently in that sell-off in EV stocks, but really just benefits from that rising vehicle production and the battery demand this year. So I do prefer competitor Albemarle, that's ticker ALB, and that long-term lithium play. It's got a little bit longer history of production. Is obviously producing revenue right now, but LAC here could produce the higher returns as that startup growth name in the segment. FedEx, ticker FDX, also going to be reporting its earnings on Thursday, with the market expecting earnings lower by 41% over the last quarter and 34% down from year over year. A competitor UPS barely beat on its earnings expectations, and really profits for trucking companies been particularly weak as well. So we're seeing weakness across this transportation segment, from the longer distance trucking to the last mile servicers, FedEx, UPS, very weak across this. Shares of FedEx not particularly cheap here either, at 16 times on a price to earnings basis. So I'm thinking the upside likely isn't worth the risk on this stock, but I'm still going to be watching for what management says about that shipping demand over the rest of the year. Going to be a very important outlook as far as consumer demand, shipping demand, and how the economy is going to play out in terms of transportation. Even though it looks like the market is going to open higher today on that backstop of the SVB losses, investors are going to get no relief from market stress over the next couple of weeks at least. We could get two inflation reports this week, the CPI and the PPI, and then next week is the Fed's meeting. So they're likely expected to raise rates by at least 0.25%, maybe even as high as 0.5% next week. Continue that rate increase that's going to weigh on the market. The consumer price index there is released on Tuesday, with expectations for prices to have risen 6.1% from last year. That would be a little bit lower than the 6.4% pace we saw last month. expectations for core CPI, right, to come down just 0.1% to a 5.5% annual pace. So again, last month, surprisingly high CPI report, that consumer prices last month, followed by a high PPI report. That really was the first to broke that bull run. Okay, so stocks started rising in October, made it all the way to last month, to February, before those surprisingly high inflation reports really put a hit into that bull run, started stopping. A 0.3% drop in the headline reading and just 0.1% decline in the core CPI, so core consumer price inflation, I don't think is enough to really turn investors positive on this market. So I think unless you get anything but a very low CPI report here on Tuesday, I think it's going to remind investors that even though some of this some of the bank risk has come off of the market, you still have that inflation risk and the risk to higher rates over the near term. So I think that's probably gonna ding the market. Check out that no penalty CD from CIT Bank with the link I'll leave below. Great place to park your cash while you're waiting for all this market craziness to subside. 4.1% return on your money with that. Or click on the video to the right for the Dividend Kings with 50 plus years of increasing payments. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.